If you have money in a basic bank account, it feels like the safest place. However, when we look at long-term historical cycles, keeping it in cash is often a guaranteed way to lose value. This chart tracks cash purchasing power against a 4% inflation rate. Even with a modest interest rate, taxes on gains often leave you with less. Over a decade, the invisible mechanic of inflation erodes the actual utility of your savings. Billionaire investor Ray Dalio argues that this loss of value isn't an isolated event. He views it as a primary indicator of a much larger, recurring historical mechanism. Dalio maps this on an 80-year timeline he calls the big cycle. It tracks how empires rise through productivity and fall through debt. Based on his metrics, the U.S. has entered the final stage of this curve, the collapse period. From this perspective, the decline in your personal purchasing power is a localized symptom of the same debt dynamics that have historically preceded the shift of world orders. To see the risk, we have to distinguish between wealth and money. On the left, we see wealth, represented by assets like stock prices. These make you a paper billionaire, but you can't spend them. On the right is money, liquid currency for debts. To get money, you must sell wealth. The disparity between paper valuations and cash is near historic highs. When central banks raise interest rates to fight inflation, the cost of holding debt rises. This forces investors to sell their paper assets at the same time to raise the liquid money they need to service those debts. This mass liquidation causes market prices to drop sharply. Investors who borrowed against their previously high valuations find themselves in a trap, owing more in debt than their assets are now worth. The current expansion relies on high valuations and cheap debt. A combination historical cycles show is vulnerable to any sudden shift in interest rates or liquidity. As bubbles burst and credit becomes scarce, companies shift their focus from aggressive growth to immediate cost-cutting to ensure they can survive the downturn. This environment accelerates automation. For example, autonomous systems are already being developed to replace the 9 million drivers currently working in the global gig economy. This follows the same pattern as the agricultural revolution. Just as the tractor eventually replaced the physical muscle required for farming, AI is now performing tasks that previously required human reasoning. While these technologies increase overall productivity, the revenue generated often flows entirely to the owners of the capital. This isolates the broader workforce from the profits of the very tools replacing them. When a massive wealth gap combines with high unemployment, tax revenues for the government vanish. Historically, this has led to intense internal conflict and political instability, as different groups fight over a shrinking pie. AI integration is likely to widen the gap between capital owners and the workforce, pushing domestic tensions toward the breaking point. A nation struggling with internal debt and political division eventually loses its capacity to maintain its standing on the world stage. We saw this with the British Empire. Their inability to maintain control of the Suez Canal signaled to the rest of the world that their era of global dominance had reached its limit. Today, the U.S. faces similar challenges in global choke points like the Strait of Hormuz. When an empire can no longer definitively secure these routes without risking a conflict it cannot afford, its power is being tested in real time. This perceived weakness encourages other nations to act on their own interests. The result is a shift from a world led by a single superpower to one defined by competing regional powers. The final stage of the cycle is reached when the economic and military leverage that once defined a world order is no longer enough to deter its rivals. Survival in this environment requires looking past daily market volatility and recognizing the broader historical patterns at work. Financial security during a debt crisis often involves moving away from paper bubbles and fiat cash. Diversifying into hard assets that cannot be printed, like gold, is a standard historical defense against the devaluation of currency. To protect your livelihood from automation, you must focus on extreme adaptability. This means moving into roles where human intuition and emotional intelligence act as a partner to AI, rather than a direct competitor. By aligning your career and finances with the debt cycle, you can move towards security while others remain anchored to a fading system.